Hey, welcome back to the Mortgage Mastery Theater. I've been getting a lot of traction on my construction loan video series and lots of questions around that. And a lot of those questions have to do with how does money move around? How does my money move around that's going to be into the deal? My being you, the borrower, the person who's building the house. How does the lender's money move around? How does the builder get the money? A lot of questions around those. And so we're going to talk a lot about just how the money moves today in this video. And so I kind of want to go through this somewhat chronologically, and you can see I broke it down to kind of where what point in time money moves. Does it move prior to closing, at closing? So at the time in which your construction loan is opened up, your first draw on that construction loan happens. That's not at when the project is done. That's at the very beginning when the lender starts dispersing money. Does it happen during construction? And then what happens after completion? So we're going to look at these various categories of cash movement and just talk about some of the logistics of these things, some questions, some traps, potentially some common misconceptions. So, first of all, just land purchase. Now, as I've talked about in another video, you can look at that in here. Financing the purchase of land with a construction loan is technically possible. It's kind of rare because practically it's just very difficult. There's so many things that have to happen in order for you to buy that land, and if you're going to fund that with a construction loan, then a lot of other things have to happen with regard to the project that you'd have to do on the land you don't own yet. So all the costs that go into planning, permitting, getting a contractor, and you don't even own the land yet. So anyway, talked about that before. But generally, you're going to put a down payment. You're going to have the land already. You're going to have the land. Either you already own it, you own it free and clear, or own it with a loan. And so any money, if you've already owned it and you own it free and clear, then there's no cash involved at that point, right? Now, if you bought it ahead of time and you finance that, then there's down payment on the loan, and of course that's going to happen prior to closing. You're going to put that down payment prior to closing, whatever that money is. Now there's a potential trap here. Now let's say that the land is going to cost you $250,000 and you only plan all in to put $200,000 cash into this deal. But let's say you've got $250,000 or more than that available to you, even though you don't plan to use it all for the construction loan. You think, well, I'd rather not go through the hassle and the expense of getting a land loan because they are tricky, quirky, really very nichey. And so I'm just going to pay cash, and then I'll get that back through construction. Well, just be aware that there is no cash back to cover your excess land. So if you just say, look, I've got the 250, even though I only plan to put 200 into this whole project, I've got the 250, and rather than get a loan, I'll just put that in until I get my construction loan, then I'll get that extra 50 back. Well, you can't get that back at that point. So just be aware of that. Whatever you put into that land, typically that's going to stay into that land in terms of cash investment. And during the construction loan anyway, of course you can down the road do a cash out refinance if you want. But so just be aware of that. Of course, your land cost is going to be put into the deal prior to closing, and potentially at closing if you're financing that with the construction loan. Now, what about some of these land preparation costs? A lot of times, and we're going to look at these things here. These things such as well, utilities, feasibility, septic, etc. A lot of these things cost money typically, and many construction lenders will not lend on the loan, will not close a construction loan, for example, if you don't have a well. Some of them won't do it, depending on the water situation in the particular area where your land is situated. Now, if you're on if you're on public utilities, water, sewer, and all that, and you've got all of those available at the boundary to the project, well, you're not going to have any trouble with that. Maybe I have to pay some minor costs associated with that, but there's no question mark about where that's coming from or what it's going to take to do that. You're going to have a hookup fee, and that'll be included in your construction loan. But if you need a well or a septic, typically there's going to be some sort of septic design. You don't necessarily need the septic built, but you'll probably need an approved design for your septic ahead of time. You typically need utilities to the boundary in order to fund a construction loan. So, if you're way off the grid and you need to go a long ways and do a lot of expenditure and a lot of work to bring utilities to the property, That could potentially be something you have to lay out ahead of time. And then a well, depending again where you are, some places require an actual well that's functioning before they will fund the construction loan. Sometimes they just require a well permit, but just be aware of those. Now, those you see I have those bracketed in X's here. Bracketed X's at closing, meaning you can get reimbursed for these things at closing. So if you put this money into the deal, you can get reimbursed for those. But just be aware that you have to very carefully, most lenders have very specific rules about getting reimbursed for prepaid items is what they call these. These are prepaid items. You paid for them in advance, but you plan to get recouped for them. And there's very specific documentation, receipts, and all of that stuff. So just be very careful. But you could get that back potentially at closing. Now, these soft costs are essentially going to be in the same category as these land prep costs. They're virtually treated the same. They're very similar in terms of plans and specs and your architect. You're spending money a lot of times on these soft costs ahead of time, and these are things that you can actually get reimbursed for. And so again, the same caveat applies. You do have to very carefully document these things, and so just be aware of that, and be aware that lenders have to verify that the funds you use for the loan are valid funds, that they're not dirty money, that there's all kinds of reasons, regulations that they have to do the things that they do. So just be aware that it's not necessarily saying, here's my receipt, here I've got my receipt, and it says, my architect was $10,000. You may have to prove where did that money come from that you spent to pay the architect. You may have to source that. So just be very careful about those things. Be very specific with your lender about what's going on there, so you're very aware of those. This is one that sometimes catches people by surprise, and that your cash into the deal. Let's say that you're going to build you're going to build a project, and it's $300,000 land, it's $400,000 construction costs, $700,000 all in, and you're going to borrow $500, and $200 is going to be out of your pocket. Sometimes people think that, I'll put that in when the loan runs out of money, right? So, when we get to that point where we've spent the full $500,000 of my loan, then I'll put my $200,000 into the deal. And that's just not the way it works. You have to put all the money that the deal is depending on you for in at closing. That all goes in right at closing. You can't save that for later. You can't keep it invested. You can't earn it later. The lender's not going to take any chances with that, and it's pretty obvious why. I mean, they can't. The lender can't get into a situation where they've got a construction project, they plan to lend $500,000, and then you had that invested in the stock market and value went away, or you blew it in Vegas, or whatever. There's all kinds of things that can happen to money, right? It flies away, as the scriptures say, right? So they don't want to depend on that. They want to make sure they get that money into the deal right up front. So that money's going to go first. That money's going to go in right at closing, so just be aware of that. Now, what about during construction? During construction, you're primarily only going to be responsible for these things right here. You're going to have, your real estate taxes, your homeowner's insurance, so your county taxes on the property, your homeowner's insurance. Now, the homeowner's insurance may be factored into the construction loan. There's what's called course of construction insurance that typically you have to get while they're building, because the risks are different and the parties are different during construction. So you get a specialized insurance policy, and maybe the builder's policy covers that. So you may or may not have the regular type of insurance, but if you do, your regular homeowner's insurance, you have to pay that during construction. Real estate tax is the same. Interest on the construction loan. The interest, the construction loan goes up gradually, right? It starts small and then the balance goes up over time. And you're only paying interest on the actual outstanding balance of that loan. And so just be aware of that's, you will be making interest-only payments, and they will be growing because every month more of the construction loan is going to be dispersed, and so the interest will grow on that, and so you're going to make those payments over time. You don't make principal payments during construction. Principal doesn't happen during construction. Principal only happens at the end of construction. Most of these loans, there are still companies who do two separate loans for the construction loan and then the modification loan or the permanent loan. Many lenders now offer just a one-step construction loan where it automatically rolls into that fully amortizing 30-year fixed rate or whatever your loan is. And usually these loans have a term of 359 months. 369 months, because that 9 months initially is that construction period where you're doing interest only, and then it rolls into a regular 30-year fixed 360-month principal and interest payment, and that happens at modification. That's when you will start to do that. So another item just to be aware of, cost overruns. Most of your construction loans are going to require you to have a built-in reserve contingency for cost overruns, 5%, 10%, depending on what your relative situation is, how much you have in reserves. But just be aware that if your cost overruns exceed that contingency, you may have to pony up additional cash. That'll be a negotiation between you and the lender and the builder. If that happens, hopefully that's not the situation. Most of these construction loans are required to be fixed cost construction, where the builder's saying, here's what it costs, not time and materials, because the lender wants to make sure that they're lending on a project that they know the cost of. They can't approve you for some indeterminate number based upon what happens with the builder's management or the cost of materials or whatever happens during the course of construction. So most of the time you're going to have a fixed cost construction loan. It will have a contingency for the inevitable various overruns or variances from estimates that are going to happen. Of course, we're not perfect. But if you exceed those contingencies, then you may have to fund that through the closing process. And what about the reverse situation? So what happens if you have unspent loan funds at the end of the process? Let's say you're one of those lucky ones who you go through the whole construction project and the amount you had to allocate doesn't actually get fully spent. You came in under budget. So what happens then? Do you get that cash back? No, what's going to happen there is that's just a principal reduction. Let's say you were approved for 500, but the lender only dispersed 450. That extra 50 just goes away. They never disperse it, so you're never paying interest on it. And then when they do the rollover or the modification of the permanent loan, they're only going to roll over the $450,000. So it's not like you get to have that extra $50,000 in pocket or walk away with that. And then, okay, what happens construction loan disbursements? Now, what about during construction when you've already got into the loan, you've done all your prepaids? At closing, typically the first draw on a construction loan is paying off the land lien. If there's any kind of a mortgage or a lien against the land, they're going to pay that off, and they'll repay any of those prepaids we talked about here. Any of those items that you repaid, you can get those back at closing. But then after that, it just goes into, you have a very detailed contractor cost breakdown, and it's very detailed by, this is the foundation, this is the framing, this is the sheetrock, this is, et cetera, et cetera. And every one of those elements has a cost associated with it. And so every month, the lender is going to come out and send an inspector out there. Typically, every month, they're going to send an inspector out there and go, okay, I see that you've got the foundation in, check. We see that we've allocated $75,000 for the foundation, and they'll cut a check. Now, this is where it varies. Some lenders will cut a check to you, and you'll cut that check to the builder. Most won't do that. Many will cut a check issued in both names where you both have to sign it. There's some obvious benefit to that, right? Because you're both having to approve that this work has been done. You, the owner, feel comfortable with that, right? You're not allowing the builder to be paid just on the basis of the lender going out there and checking it off, but you have some authority to say, yeah, go ahead and release those funds. So sometimes there'll be a dual signature check with you and the builder, and then sometimes it's just the builder only. But those funds are dispersed that way. That's really all I have right now for this. Appreciate any comments, questions that you have. Keep them coming. And thanks for watching. Subscribe to me, like me, follow me, all those things that help us be profitable. Thanks so much.